I'm Chris Stanley, your friendly neighborhood semiconductor analyst here at Citigroup. Next up, it's our pleasure to have one of the big kahunas of semis, very appropriate for a lunchtime keynote, Intel. And we have CFO extraordinaire, Dave the Hammer Zinsner here to answer my questions the Hammer Zinsner, answer my questions. First of all, and there is Dave right up there with that excellent picture. Intel made us put that up there, not Dave, just to clear the air. And I'm supposed to read the disclosure, so let me give it my best shot. Before we begin, please note that today's discussion may contain forward-looking statements that are subject to various risks and uncertainties and may reference non-GAAP financial measures. Please refer to Intel's most recent earnings release and annual report and Form 10-K and all other filings with the SEC for more information on the risk factors that could cause actual results to differ materially and additional information on our non-GAAP financial measures, including reconciliations where appropriate to the corresponding GAAP financial measures. Thank goodness that's over. All right. So let's dig on in. Now that I'm done auditioning for the auction house, I'd say one of the bigger positive surprises for Intel this year, Dave, has been you guys gaining back market share earlier than some of us would have forecasted on both the desktop and the notebook side. So let's talk about what triggered that, and what we can expect going forward. Do you expect those share gains to continue?
Yeah. So first of all, thanks everyone. Guess I never had a crowd like this. I mean, a free lunch will get a lot of people.
It may be his wedding.
I'm gonna serve lunch every time I'm speaking now. Yeah. So obviously, we have had some challenges on the product side and on the process side, and Pat came in at the beginning of 21. Job number one was to get that rectified, and on the client side, I think we've done a really good job of getting products to market in a timely fashion, with good performance. Of course, we've got a really strong ecosystem, in particular in the enterprise side of the client space, and that's helped us, kind of get the share back. And I'm really excited for Meteor Lake when it comes out. We should qualify that this quarter. We'll have our pre-PRQ, and then ramping thereafter. And so that product has particularly good performance. It's the first tile architecture for us. It's also on Intel 4, so we're starting to get into EUV, EUV processes for the product, and it has an NPU. So it actually is our first product on the client side that addresses AI in some respects. So I think that's helped out a lot. We've gotten, I think, much more focused in terms of providing value to customers, getting a stronger engagement with the customer base. I think that's also helped a lot in terms of rectifying things. I think at this point, based on where we sit on share, we feel pretty good. I mean, we feel like we've really righted the ship on the client side of the business, and now it's a matter of just continuing to execute on the products, continue to bring them out with new processes, and I think that business will largely be defined on how the market grows. We actually think 24 is going to be a pretty good year for client, in particular because of the Windows refresh, and we still think that the installed base is pretty old. And does require a refresh, and we think next year may be the start of that, given the Windows catalyst. So we're optimistic about how things will play out beginning in 24.
So let's dig into that a little bit. I think what's really interesting to note is you guys raised pricing, and then your market share went up.
Yeah.
So do you think that any particular product on the client side really spurred that? And then maybe talk about some additional products down the line you think will give you another step function higher in terms of share and performance as well.
Yeah, I mean, Alder Lake was a great part when we introduced it, and we knew it was a great part. We thought it drove good value to the customers. Generally speaking, our customers get a premium with our particular CPU. So we recognize that there were some inflationary costs that we incurred over the course of the last couple of years, and had not passed that on to customers. Given the performance of the part, the quality, and so forth. We thought it was a good time to even raise pricing, and still, be able to drive a commanding share.
Great. And so switching gears a little bit to the server side, the death of your server business has been greatly exaggerated. You're still pulling in, roughly 3/4 of the market out there. Why do you think, your share has not eroded like some would have predicted, or even like what it's done in previous cycles when your main competitor grabbed the upper hand?
Yeah. Well, I have to say, even coming into this year, we would have expected market share erosion. And in fact, in Q1 and Q2, if you look at the surprises we had relative to our guidance, I think that was in large part due to the fact that our share did better on the data center side. I think Sapphire Rapids has turned out to also be a pretty good product. One area where it really distinguishes itself is in AI workloads. And as it turns out, that just so happened to be the place where things were really moving rapidly over the course of this year. And so I think it benefited from that fact. And actually, when you look at it, we were thinking we would need to see China come back in a big way, which would help out the enterprise side of the business. And we're better positioned even on the cloud space in China. And yet that has not happened. We have not really seen China come back in any material way. And yet, that business actually has performed better than expectations. That said, I don't think we're out of the woods yet in data center. Sapphire is a good part, but it doesn't address customers' needs in all cases from a TCO perspective. And, so we still have to get, more products out. Emerald will come out later this year. That will be a good step in the right direction. But really, it's when Sierra Forest and Granite come out in 2024 on Intel 3 that I think we really start turning the corner on a product performance basis. And then I think we have a real opportunity to improve our market position from there on.
So do you think that either Sierra Forest or Granite will start to result in you increasing market share?
I think it stabilizes. I think 24 will be a year of stabilization, quite honestly. And then as we get into the 25 timeframe, Granite is starting to really ramp in terms of customer traction. We start to see Clearwater Forest come out. Then I think you start seeing what we would expect is a better share position. We start to have real product performance advantages.
Great. In terms of other hot topics, I would probably be run out of town if I didn't ask about AI and Intel. Sounds like you guys have been talking about some nice traction for the Gaudi product. Maybe give us an update there, and then we'll move to other areas as well.
Yeah, so we have Gaudi 1 and Gaudi 2 out. And given the I think the challenges in getting GPUs, I think we see more customers taking a look at Gaudi as an alternative. In addition, the price points are better and more attractive. And when you look at in certain models, and in particular, as you look beyond the really big parameter training, that requires scrubbing the whole internet, you start to get, you look at it in a more contained environment, particularly, on-prem searches. It has definitely got a real, performance level that is equivalent to what you see from competitors. So, we think that we have an opportunity to really drive some good traction on that, in particular together with Sapphire on the CPU side. We talked about on the earnings call that we had over $1 billion worth of pipeline.
Yeah.
A pipeline is, what you might imagine. It's, just basically, any customer that we could potentially see some business from, who's expressed some interest, we're counting. That then has to be converted to real dollars. And, of course, not all of that converts to real revenue. But the pipeline itself is building every day. And it's meaningfully bigger now than it was when we talked about the $1 billion number. I would suspect it'll be meaningfully bigger by earnings call relative to where we stand today. So we continue to see that business be attractive, and that will really be our story in 24. Is driving Gaudi together with CPUs. Ultimately, we will have our Falcon Shores product, our GPU out in 25, and a lot of that is building the software ecosystem. We think we provide some real advantages from a GPU perspective with that software ecosystem. We've talked about this one API, this notion of an open, platform that's really hardware agnostic. We think that's where the industry wants to go ultimately, and so that's how we're going to support our customers as they build out their AI workload.
So would you expect Gaudi to ramp before Falcon Shores?
Absolutely. Gaudi is ramping today. We'll have Gaudi 3 out here in a reasonable period of time, and those products should ramp all through next year.
When do you think it will be, I guess, material revenue? Let's say hundreds of millions. You guys are pretty big, so let's say hundreds of millions.
I think next year will be material. I mean, we'll have revenue this year. That's not negligible by any stretch, but it takes time to get customers comfortable and having run the accelerators on their particular workloads. So that takes months. And but I would say if you look at we stood up Boston Consulting Group. They wanted to do a large language model within their own environment, fully secure within their own environment, but it had significant amount of parameters that it was searching, and I think we did that in about 12 weeks from the time we started talking to Boston Consulting, the time they were actually running that. And by the way, I was just at a dinner with their couple of their consultants, and they're super excited about it. They're seeing real opportunity to leverage this with their customer base. So I think this will be one of those things where it just has to build momentum. Every quarter, I think we'll be able to say we've built momentum and seen strength, and I think next year will be, it'll be a material number.
Great, and I know you're a finance guy and a margin guy. What should we think of the margin profile for this product for Gaudi?
Oh, margins are accretive. Yeah, this is a good business for us.
Great. Sorry, I'm just scribbling all this down. And is that manufactured at Intel now, or is that on Foundry?
It's not. We're using Foundry.
Will that come over to Intel at some point?
Yeah, I mean, really, what will happen is Gaudi will converge with Falcon Shores. It'll be one product offering, and I think you'll see over time our Foundry will compete with other foundries for that business along with others.
Yep. Yes, let's talk about Falcon Shores and then graphics, particularly as it pertains to AI. Maybe just give us an update on that, and then when would we expect, I guess, meaningful revenue in discrete graphics from you guys?
Yeah, 2025 is when it'll be out. Obviously it'll take time for it to ramp. And obviously the software has got to be there, which is what we're developing as we speak, and obviously that takes time as well. As it relates to and you mean discrete graphics in the client side? Is that what you're asking about?
Yeah, exactly.
Yeah.
Montevecchio and whatever follow-ons are after that.
So on the discrete graphics side, what we have strength in is integrated graphics even today. So we actually have a good position. Our discrete, we have a plan to build out the discrete graphics business over the course of the next couple of years, and I think we're leveraging the GPU technology across both the data center and the client space in a way that I think should be pretty efficient way of developing those products. So all looks good.
Sounds good. So a comment that your boss made last week, I would feel remiss if I didn't ask about that. You guys are
made a lot of comments.
Yeah, that's why you love him.
He was excited.
So he stated that the quarter was progressing better than expected, and that was like halfway through the quarter. So it must be a lot better than expected if he's already saying that.
Yeah.
Could you just talk about where you guys are seeing the the upside?
Yeah. So what he said was that we are tracking above the midpoint. Of course, core's not over yet. We gotta finish strong in order to be above the midpoint for the quarter. But things are going better than we had planned. We had expected client to be up, and client is up. So it's relatively consistent with what we thought coming into the quarter. I'd say on the networking business, the NEX business, we expected that to be weak, and that's played out largely as expected. Really, where the surprise has been in the data center business, the DCI business. Now we do expect that to be down quarter over quarter, but I think it's safe to say that it's at least tracking better than we had anticipated. So it's maybe not as down as we had originally thought coming into Q3.
And
why is that?
That was my next question.
So China's still relatively soft, so it hasn't been from that. But Sapphire as a product has done better, and we'll see how as we exit the quarter how we do in terms of market share. I suspect we will have done better than we had anticipated for the quarter once everything is set. I think that's part of it. And as I said, Sapphire is a product that happens to be pretty good suited for AI workloads. So I'm sure we're seeing some benefit from that across both enterprise and cloud.
Great. So just so I have it straight, the better than expected was entirely from data center, and basically everything else is about what
Everything else is pretty much as expected.
Okay.
Although doing different things, obviously.
And has this strength flowed into bookings as well for the future? Have you guys seen bookings start to show?
Yeah, I mean, probably early to say how Q4 is evolving. I would say maybe the best thing is we felt like the second half of the year for 23 was going to be a strength for us relative to the first half, and that is playing out as we anticipated, and even surprising us a little bit to the upside.
And where would you be most excited about for 2024? So you mentioned that you think your server data center market will stabilize. You expect to keep gaining share in desktop and notebook. How about the rest of the businesses? Let's leave Q4 out, but let's talk about next year.
Yeah. I think data center, given the new products and the opportunities within AI for Gaudi, I'm excited about the data center business. On the client side, that business doesn't necessarily grow at breakneck speeds, but given the opportunity for a refresh, midway through the year or so, and how good the Meteor Lake product is, and just the opportunity given its application to AI, I feel really good about the client business as well. Maybe go back. The other thing on the data center side is, we have suffered through inventory reductions, for several quarters. That's likely to continue through the rest of this year. But I think after that, we'll have kind of worked our way through inventory. And so that business has, I think, an opportunity for a tailwind like client is seeing right now, where it just kind of moves up to what, basically instead of bleeding through inventory, our customers now have to buy everything from us. So we get that lift from that as well. NEX will likely have that similar dynamic. It might be a quarter or so later than data center, but sometime next year we should start to see a little bit of a lift from them. And I have to say, the other one that I'm excited about is the foundry business. While it's probably early to get a lot of loadings on wafers, particularly since a lot of it's going to come.
Down payments count for foundry revenue, right?
But packaging is looking very good for us. And packaging, we can turn to revenue, in a relatively short period of time, measured in months, not years. Wafers, it's years before you turn that into revenue. And we are getting a lot of traction. And I love the fact that, not only are we getting revenue from it, which pays the bills, but also it's a great kind of lead in for customers where we, get them engaged with us on a packaging side, and then kind of convert them over to be customers on the wafer side, and so I would it's relative to the size of our business, it going to move the needle significantly? No, but it's a good bit of business, and it definitely, I think, gives us inroads for later on the wafer side.
Great. So just to run through some of those, I guess, how do we reconcile what certain large semiconductor companies are saying about AI, and all of the budgets are going towards graphics, and then obviously you guys are seeing a little bit better than expected trends, and we don't really see a lot of the CSPs increasing CapEx. I know you guys talk to them all the time. What do you think is going on? You think it's maybe not as bad as some had feared, or what's your sense?
Well, look, I think that at the moment, given these, big, large language models, 100 billion plus level parameters, there's a need for, heavy duty GPUs to do that work. We I think are a beneficiary of that because of the CPU that we have. But clearly, the biggest beneficiary is, the company that, sells those GPUs. But, over time, we view AI as a workload. It's not necessarily a market. And so, if it's a workload over every market we serve. It's, yes, on the cloud side, but also on the enterprise side, the client side, at the edge, in the network. And, as you move farther away from the cloud, the opportunities for it get bigger. Because, the architecture that works for a cloud service provider is not the architecture that works for an enterprise customer in terms of the cost of these systems and the power usage of these systems. And so we think there's a lot of opportunity for us to play in this space and generate revenue that makes this a meaningful tailwind to our business, regardless of what market we're talking about. So I actually think that this is a huge positive for Intel. Now, in the near term, we acknowledge that there's a lot of dollars going to GPUs, for large language models, and that definitely takes a little bit of the wind out of the sails of our data center business, and part of the reason why we think Q3 and Q4 will be more muted than they have been in the past. But I think as we go into 24, I think there's a real opportunity for us to see meaningful growth from AI.
Great. Before we dig into manufacturing, another announcement you guys made recently was signing up a foundry. I think it was a prepayment, a down payment, something like that, layaway, whatever, for 18A. So can you expand upon that? What kind of customer is it? When can we expect this to be delivered? And are they locking into a contract, or is it just we see the capacity coming on and we want to get first dibs? How exactly?
Yeah, I would characterize it as we're engaged with several customers, and as we've talked about, we thought we could get what we call a whale done.
Would this be a whale?
By the end of the year. This will be a whale.
Okay.
By the end of the year on 18A. And so one of these particular customers was pushing us to move a bit quicker, and yet we're not all lined up in terms of the definitive agreement and all that stuff. And so the request was to accelerate. What ultimately the request was driving was an acceleration of our Arizona build out, which of course requires capital, but also a commit. We needed to see a little bit of commitment from the customer, make sure that they were really serious about the demand. So they, as a kind of, I call it a show of good faith, and to support us in terms of accelerating Arizona, put up what Pat said was a meaningful prepayment. You could call it a down payment too. I guess you could just as right. And so we're going to get going on accelerating Arizona to get that out. 18A really isn't in production for foundry customers probably until the 2025 timeframe. So it would have to be out a few years before we actually see the revenue from it. But in order to get going now, to get production out, we got to accelerate what we're planning to do. I look at it as a great endorsement of 18A. Obviously, they had to put 18A through its paces a bit to get comfortable that we would be the right partner. So I think it's a good validation of where we stand. That said, we still don't have our 0.9 PDK yet out. That should be out pretty soon. And that, I think, is really where you start, seeing customers get real serious around, okay, now we got a 0.9 PDK, we can kind of, track our way to one. It's time to start, locking in agreements for the volume. And the good thing about this business, I think we are, we're well situated in terms of the dynamics that are going on across the industry. We got geopolitical concerns. We went through a lot of supply chain issues in the past that weigh on the minds of customers. There's some competitiveness challenges that purchasing departments have, and so our goal is to help alleviate that in the industry and be kind of the Western supplier for wafers for customers.
And I think earlier in the year, you guys mentioned you were working on 2 potential large customers.
That's still the case, yeah.
So was this one of those 2, or could there be?
Yeah, this was one of them.
And then should we expect something on the other customer by the end of the year? Do you think this helps your case, certainly with the other customer?
Yeah, maybe. I mean, look, it's nothing's done until it's done, So we're working with both customers to try to make sure they're comfortable with our process and our manufacturing and what the plan is, and get them comfortable with the terms, that we can both live under. And if it's never over until we get all that stuff sorted out and a document signed. I'm optimistic that both of them could be signed. I think we are absolutely committed to try to get one signed this year. And I just point out that in addition to that, we're likely to I think have some announcements on the packaging side as well. So some of those might be overlaps, some of those might be other customers that we're engaged with.
Yeah, certainly we would think packaging would ramp a lot quicker than foundry.
Sure, yeah.
And what would be the margin profile in the packaging business?
Remarkably, because this is advanced packaging, pretty difficult to do and does drive performance advantages to customers, the margins are actually fairly good. Now, all of the
corporate average good, or good close to corporate average, or?
In the foundry space, the margins are lower than the corporate average, so obviously that's, you got to take that into account. But I mean, this will be accretive certainly to the foundry margins.
Got it. Yeah. So maybe just spend a minute on, when we could expect meaningful revenue from, I mean, you already have what, $1 billion for foundry or something like that, but in terms of the leading edge or the bigger customers, when we could expect meaningful revenues from that business, and then what's sort of the business model, when you guys are maybe not fully loaded, but let's say 5 years out, or we're looking at the foundry business, are we thinking 10% growth per year, and are we thinking 50% gross and 30% op margin, or 20? But give us a sense of what the sort of the ideal business model would be in, say, 5 years.
So it will take time to ramp this thing. It's going to be somewhere in that kind of range for several years. But I do think, by the time you start running into maybe 26, 27, you'll start to see some real revenue that moves the needle. That's probably what to expect. Obviously we've got to get the customers to sign up, but assuming we can do that, I think that's really where you'll start to see meaningful revenue. I'll get in trouble from Pitzer if I announce the model before he wants to announce the model. I would just tell you that these margins can be quite good. The gross margins are likely to be lower than the corporate average, but the OpEx intensity is likely to be much better than the corporate average. And so operating margins actually can be pretty comparable to the overall model. Maybe not quite to the 60/40 model, but certainly, at a healthy level.
Sure. Before we hit manufacturing, might as well talk about the long-term model. And by the way, this is intended to be interactive. So if anybody has any questions from the audience, it's hard to see, but feel free to raise your hand and we'll come grab you with a mic, and hopefully somebody will get my attention. You guys recently came out, not recently, but came out with sort of this growth model with double-digit revenue growth is the goal. Maybe just run down how you guys got to that, and then what would you expect to drive that growth? What would be the higher growing areas, and then some of the lower growing areas? And then
I mean, obviously, the model is heavily dependent on the TAM growth and how TAM grows over time. But But I would say, client is this kind of low to mid single digit growth market. Data center with AI and so forth is certainly in the double digits. NEX, last I looked, was kind of in the high single digits, maybe approaching double digits. Then we have what I call the wild card, which is the foundry business, which may be immeasurable, given that if it comes, it'll be ginormous, in terms of its growth. And so that gives us a lot of opportunity to drive revenue growth. But I have to say, the way we're planning the business is more modest than that. We're thinking, okay, let's do all those things necessary to drive that growth, but let's manage the business from a capital investment perspective and operating perspective to be conservative around that. And so a lot of that stuff then becomes upside if it shows up, but we haven't gotten ahead of our skis in terms of spending for the business. So that's been my approach to how to manage.
Okay. And on the margin side, I've known you for 20 years in 4 different companies. So Intersil's margins went up 10 points, ADI's margins went up 10 points, Micron's margins went up 40 points or something like that. The Intel gross margin range was, I think, 55 to 65, then it was 55 to 60. What should we think of as sort of the long-term gross margins for Intel? And then what will be the drivers to, take it to the high end of the range or higher, or, God forbid, what could, disappoint and bring it to the lower end of the range?
Yeah, I mean, the trick of this is to drive a margin that is really good, but also, takes into account the size of our business and the share we want to have and so forth, and the fact that we want to be in the foundry business, which doesn't generally operate at 60+% gross margins, with one possible exception. And so, I think the goal would be to drive a 60%, and Pat's talked about this model of driving 60% gross margins. That's probably the optimal sweet spot for us.
50 to 60 kind of thing?
What's that?
50 to 60?
60, to try to be in the 60 range. Now we're, 15 percentage points below that roughly. And so we've got a lot to do to cover the gap. And I think it's a couple of things. One, getting process leadership and getting products back to their rightful place, I think, is number one most important thing we can do for the business to generate good profitability. That kind of is number one thing. Outside of that, there is a ton of efficiencies that we can get within the business. And so, we've talked about this thing where we're kind of separating out the manufacturing, which is going to look like a foundry business that provides wafers and packaging services to not only external customers, but also our own internal customers. And so, by doing that, we kind of isolate that business as P&L now and be able to measure that relative to peers. And you're not going to be surprised to hear that it's woefully inadequate. It's not in a good place. But just having that clear view of how it operates will drive a lot of behavioral changes at the company. Better loadings, more intelligence around how we increase our capacity, less hot lots and unexpected wafer starts, a better dynamic of how we mix our business. Right now they're constantly moving the mix around, which is not an efficient way to run a fab that now supports multiple customers. Less sample activity, only the sample activity that we need. And so there's like billions of dollars of savings opportunity there that I think will greatly improve the business. We'll also, once we get through this 5 nodes in 4 years, there's a huge amount of cost in startup costs, billions of dollars incrementally higher than we normally operate in terms of startup costs, that go away and improve. And then, of course, revenue cures a lot. And so as we improve our revenue, the fall through is quite significant. We should see good margin expansion from that as well.
Do you think just regaining process leadership should probably get you to 60, and then anything after that in terms of the costs, et cetera, would be well above that?
I think
that's what we've written.
That's what you want, did you say?
We were written. What I want too, yeah. I'm an American, right? I want Intel to succeed. I'm a
Yeah.
semi guy.
Yeah,
No Intel, no daily job, no good.
I think getting leadership will be an important part of the gross margin improvement. I think what we feel committed to is driving this 60% number. If things turn out better than expected, then obviously we'll take it. But, for now, I think you should think about it as the end goal is to get to 60 as a company.
And then on the cost cuts, I think you're 3 billion into the 8 to 10 billion. Is that correct?
That's correct.
And where would you say it's come from so far? And it sounds like you're pretty confident that you could, snag another 5 to 7 billion.
Yeah, I kind of listed off a bunch of areas where I thought we could get the 5 to 7 billion, where we have line of sight to. The 3 billion was mostly we're in a down market. We need to spend less. And so it was about, driving kind of overhead efficiency at the company. And also, I would say, just driving austerity and, eliminating pet projects and the like. So that's really where we caught most of the savings. I think now a lot of the savings is going to be driven off of just driving efficiencies, operating more efficient fab, operating a more efficient engineering roadmap, being more efficient in terms of our overhead, in terms of our go-to-market. It's going to be those kind of driving efficiencies, which, in one respect are, more permanent, but take longer. You kind of iterate your way through those improvements, and those usually take multiple years to show up. So, the goal is to kind of exit 25, with most of that savings in the bag and really feel it in 26.
Okay, great. One other thing I wanted to ask was on product lines. As you start cutting these costs, are you going to have to jettison any of the product lines, or do you think it can just be all internal efficiencies?
Well, and by the way, I think this is an area where I'd say but and Pat in particular, we don't get enough credit for in terms of just enhancing shareholder return. Is we're being very aggressive in terms of looking at places to unlock value, where it may not make sense to fully operate that business within the four walls of Intel, and that unlocking it to allow our owners to get a return from that is like top of mind every day. And so Mobileye is a perfect example. The IMS business, the mask writing business, another example of that. We're going to transition the NUC business from Intel, and there will be others, I think, over time, where we'll just we'll have done a good job building it to a certain level, but to really unlock the value requires it to be more of an independent company, and that one we'll be very pragmatic about how we do that.
Great. Just to make sure we reiterate, so manufacturing is on track as far as the 4 nodes in 5 years, everything's fine?
5 nodes in 4 years.
5 nodes in 4 years, sorry.
Yeah, completely on track. Things are going well. Like I said, I would expect a 0.9 PDK here pretty soon on 18A. I already said Intel 7 done, Intel 4 is pretty much there. We're ramping Meteor Lake in the factories as we speak. We pulled in the timelines for both Sierra and Granite, and they're on Intel 3, so they look good. So I have to say, this has been one of the most significant transformations we've made, and I think in large part, the credit goes to Pat and the engineering teams that literally are meeting on this thing. I attend some of them are just completely over my head, but on a weekly, sometimes daily basis, to get this right, to get products out on time, to meet customers' requirements, and to do it as cost effectively as possible.
Great. All right, I think we're out of time. Thanks, everyone.
All right,
thanks.
thanks.
Dave. Appreciate it.